Revisions. I'm struggling to come up with a time outside of named events like the global financial crisis or even COVID when backward-looking downward revisions were so severe. We have a lot of data releases to comb through today, in addition to reporting on the rapidly changing and ever-degrading economic conditions as a result of the war in Iran. Now, the reason I want to combine a look back with what's happening right now is to anticipate the future talking points from this administration. There's no doubt that the Iran war is shaping up to be the nail in the coffin of Trump's economic agenda, but that means that it's also going to be used to cover for the serious damage that was already done during his first year of the second term. And we can't let him get away with spinning this narrative. So we're going to dig into the stunning revisions to GDP and briefly cover trouble spots in everything from jobs and inflation to mortgage rates and private credit stress. So in our top story, we'll explain key terms like backwardation, demand destruction, and fiscal dominance that help contextualize the current environment. And by the time we're through, you'll be fully equipped for that online argument with your MAGA relatives. I'm Max from UNFTR, here with the macro take exclusively for MeidasTouch. All right, let's talk about what it's like to have an eloquent wartime president that can galvanize a population around victory and shared sacrifice.
No matter how long it may take us to overcome this premeditated invasion, the American people in their righteous might will win through to absolute victory.
Oh man, I am really struggling with my clips lately. Here, let's try this one.
Watch what happens to these deranged scumbags today. He also adds that these people have been killing people all over the world for 47 years, but now I am killing them.
There's my guy. Let's kill all these scumbags. You know, these are the kind of words that get etched into monuments. This administration has painted itself into a corner with this war, which I believe will go down in history as one of the worst self-inflicted wounds of any presidency because of how destructive this will be to the economy. And that doesn't even take the human toll that any war takes into consideration, which will be considerable the longer this goes on. Now, in our top story, we're going to tackle the ways in which the war will manifest in the economy. But I think this Bloomberg headline says it all about where we are now. This economy was already in serious decline before the war began. And this is a theme that we've been harping on over the past year. But now it's in black and white with each new data release. So let's start with the revisions to GDP because they're brutal. The government just cut fourth quarter growth in half from 1.4 to 0.7%, which tells you how weak the underlying economy was even before the war in Iran. Now remember, we've already walked through how 2025 GDP was being propped up by a once-in-a-generation surge in data center and AI infrastructure spending, and how, in a prior Meidas video, we showed that without that boom, the growth story basically fell apart. Analysts like Jason Furman and others have pointed out that almost all of the first half growth from 2025 was from data centers and information processing. If you strip that out, you're left with an economy that was basically flatlining. The administration tried to hang the already anemic Q4 numbers, though, on the government shutdown. But this 50% downward revision makes it clear that the weakness runs much, much deeper. And that's after counting hundreds of billions of dollars that were still poured into data centers and the AI build-out. Now, moving over to inflation, not a lot of good news there either.
Consumer spending, real personal spending, barely rose in January, up 0.1% as Americans cut back on goods and focused on essentials like health care. Core inflation increased 0.4% on the month, 3.1% from a year earlier. And this is the Fed's preferred gauge. This is the one that they need to get down to 2% per their own goals, but haven't been able to for many years.
So this is the worst combination because you have households pulling back, but prices are still sticky and persistently high. Again, all before the war in Iran, when relatively depressed energy prices were the last fig leaf that the administration could hide behind to claim that inflation was under control. So now, let's look at the country's P&L as a whole. The latest Treasury data show that in February alone, the deficit, what we overspent, was roughly equal to the entire monthly revenue. And from October through February, the government has already run a deficit of just over $1 trillion, basically in line with Biden's last year. So not only has this administration failed to make any progress on the structural deficit, these numbers are pumped up by a surge in tariff revenue because customs duties are up about 300% year over year, which is now legally and politically at risk because the courts and the importers push back on it. So there's a real chance that even these already ugly deficit figures will be revised worse once tariff disputes are unwound. And this matters because we're already struggling to contain our borrowing costs, and there are a few new moving parts making it even harder. First off, Treasury has been aggressively shifting from longer-term debt into shorter-term instruments. They're trying to save a few basis points at the cost of a much bigger refinancing risk tomorrow, which is okay if you think rates are going to stay down. But short-term rates, which we'll come back to in the main story, are still in the mid 3% range. But the 10-year is bleeding out. 10-year yields are rising as investors demand a higher risk premium to hold U.S. debt in this environment. And that hits home because the 10-year is the anchor for key borrowing costs like mortgage rates. And as you can see here, mortgage rates had finally started to ease a bit as the housing market went into a deep freeze and sellers and builders began to budge on prices, if not outright fire sale some inventory. So now, as long-term yields tick higher on war and risk and inflation fears, mortgage rates are moving up again, threatening to choke off what little activity was starting to return to housing. Meanwhile, the backdrop in financial markets is a steady drumbeat of rising risk in private credit, which we've been tracking here for months. Strategists at UBS and Bank of America have warned that private credit defaults could climb more in 2026, and we were already kind of in panic mode. So this stress is showing up in higher default rates and borrowers deferring cash interest payments, and that's how we know. Plus, bankruptcies have revealed some pretty shaky lending practices. Now, in the last few months, we've seen high-profile cracks like the subprime auto lender Tricolor and the auto parts maker First Brands, who both went under, and BlackRock has now capped withdrawals from its flagship $26 billion private credit fund after a wave of redemption requests. So when the biggest asset managers are gating funds and top bank CEOs are talking about credit cockroaches, that's not normal. So now the Federal Reserve is grabbing a mitt finally and taking the field, which in theory should be reassuring, but in this self-inflicted environment, their toolkit doesn't work the way it used to. So instead of bringing a new playbook, they're just falling back on an old one: deregulation. Fed and other banking regulators are preparing to relax parts of the post-crisis capital framework, scaling back some of the tougher requirements on big banks' trading books and mortgage exposure in the name of boosting lending. And look, I could spend an hour on the risks of doing this into a tightening cycle, but the bottom line is simple. We are heading into a severely tight credit environment at the same time that we're thinning out the shock absorbers. So rates are getting away from policymakers, which means that borrowing is getting more expensive across the board. And there are visible cracks in the shadow banking system with private credit and specialty lenders and leveraged funds because rates in that universe were already sky high before the war. So when bankruptcies started to hit last summer, you might remember that we dug through the term sheet for one of BlackRock's investments that they took a $100 million plus loss on, and it showed that Renovo, their home improvement investment, had multi-million-dollar lines of credit at anywhere from like 5 to 9 points over SOFR, which means that their real interest rates were as high as 15%. And the one thing that can turn a fragile lending portfolio into a full-blown crisis is a severe sustained inflationary shock where these numbers get even higher. So a major war in the Strait of Hormuz and an energy-driven supply shock building is exactly what we're flirting with. And that sets us up for our top story. All right, so let's talk about the economic pickle that this administration has managed to manufacture, because it's not just bad luck or no one could have seen this coming. It's the collision of three big ideas: backwardation in the oil market, demand destruction across the real economy, and an era of fiscal dominance that makes our normal policy tools almost useless. All right, so let's start with backwardation. This is when the price of oil today is higher than the price for future delivery. So traders are basically saying, look, we know things are tight right now, but we think that it'll get better a little later. It's the market's way of betting that today's pain is only temporary. So that's where we are today, which seems okay on the surface. Spot prices have jumped on the Iran war, but the futures curve is signaling that prices should ease in the months ahead. But I think the market is clinging to this idea that it's just another flare-up that will muddle through like we've done before. But with each passing day, this assumption becomes a fantasy because this disruption, they think it looks like Iraq in early 2000s or even Russia's invasion of Ukraine, but it doesn't. So I would expect this trend to dissipate in very short order. We have to keep an eye on it. Now, those other conflicts were terrible, but the supply disruptions, if we're just being even keel about this, were mostly regional. They were anticipated and they were managed around the edges. Russian oil, for example, was rerouted and it was discounted, but it still flowed into the global system through workarounds and shadow fleets. So in this case, the choke point is the Strait of Hormuz, one of the most strategically important pieces of water on planet Earth. A gigantic share of not just global crude, but refined products and natural gas, petrochemical feedstocks, and fertilizer pass through this narrow channel. Cut it off or just partially disrupt this artery, you're not just talking about higher gasoline prices on the coasts. You're talking about input costs for manufacturing, shipping, plastics, and most critically, food. And we're heading into the front end of the global planting and harvest calendar in many, many regions, which means that fertilizer and fuel need to be moving right now, not 6 months from now. So the longer this drags on, you're talking about a supply shock that creates lower yields and higher prices, and it has a very, very long tail. So this is why backwardation is an important tell, something that we have to look at, because as long as the curve is backwardated, the market is saying we still believe that this is going to get resolved. But if this war runs for a few more weeks at its current intensity, you can expect that curve to flip into something called contango, which is where we were, by the way, where future prices rise above the spot price because the market will start to price in not just an acute crisis, but a structural shortage. And when that happens, you're no longer arguing about a headline spike in oil. You're staring down a multi-year inflationary problem wired directly into the cost structure of everything. Do you remember COVID? That's exactly what we're talking about, just it came about because of a different circumstance. And here's an infuriating contrast. When Russia prepared to invade Ukraine, we had a heads up on it. For better, for worse, we kind of knew it was coming. And the Biden administration, therefore, spent months lining up alternative supply, talking to allies, talking to foes like Venezuela, preparing SPR releases, and gaming out worst-case scenarios with energy and security experts. Now, it wasn't perfect, but it was planning, it was coordination, it was a strategy for how to absorb shocks and protect consumers. Have a listen to this.
We knew the war was coming already in December before the war between Russia and Ukraine. And so we started preparing different scenarios, and I had briefed the president at the time on here's what we do. We're going to have an oil problem. We're going to have a natural gas problem in Europe. And we started looking at all the different tools that we had at our disposal.
That's Amos Hochstein, who was an advisor to the White House at the time. And as he described, they were working the phones the whole time. They were working pipelines and alliances long before the first Russian tank rolled across the border. This administration has done none of that. It picked a fight in the most sensitive energy choke point on the planet, as we said, with no discernible plan for energy security, no diplomatic runway, and no coordinated response with allies. People can't even believe that we did what we did. And that's not an accident. This is the Trump governing philosophy, to just go from crisis to crisis and then talk tough on Truth Social and TV and hope that the markets clean up the mess somehow. That's not going to happen. The Iranians are dug in and they have all the cards right now. And now he's jeopardized his favorite thing, the stock market. So that brings us to demand destruction. This is what happens when prices get so high for long enough that people just stop buying. Not because they suddenly became virtuous savers, but because they're broke and they're out of options. And we're already seeing the early signs of this. Like we covered, even before the war, consumer spending was flattening out. Inflation-adjusted spending in January barely rose while the core inflation jumped. And that is, again, the worst combination. People pulling back while prices keep rising. And remember, energy prices were acting as a partial relief valve at that point. So when higher gas and oil increase, it bleeds into trucking costs, airline tickets, delivery fees, fertilizer prices, and the price of everything sitting on the store shelf. And for households that are already squeezed by higher rents and insurance and foods and all of the service costs around medical delivery and things like that, this could be the straw that breaks the camel's back. Because people drive less, they travel less, they skip discretionary purchases, and they stretch every single dollar just to keep the lights on. Now, on the business side, demand destruction shows up in canceled projects and hiring freezes, shifts from full-time to part-time or gig work. Margins get squeezed by higher input costs and weaker demand. And that really impacts smaller firms especially especially the ones that are financed by private credit that are already at these elevated interest rates, and they get hit first and hardest. So when these dominoes start falling in an environment of rising rates and an oil shock, lending standards tighten more and credit dries up for Main Street. Doesn't matter what the Fed does with capitalization requirements or deregulation, which is what they're focusing on right now. This is absolutely the wrong policy prescription. Now, historically, when demand destruction looms, policymakers have two levers. Central banks can cut interest rates to stimulate borrowing and stimulate spending, or governments can use fiscal policies like tax cuts, targeted aid, public investments, and so on. And this helps cushion households and businesses. But here's the catch. Those tools don't work the same when you're already trapped in what's called fiscal dominance. Now, fiscal dominance sounds like academic jargon, but the idea is really simple. In a normal world, as if we know what that is anymore, the central bank focuses on its dual mandate, inflation and employment, and the government sets its budget more or less independent of that. Now, in a world of fiscal dominance, the level of government debt and the cost of servicing it becomes so big that monetary policy ends up serving the Treasury's needs, not the other way around. And look at where we are right now. The deficit, just for the first 5 months of the fiscal year, October through February, has already blown past $1 trillion. And that's with the supposed near full employment that we had, which we've debunked before, and the full impact of this war. And it's with tariff revenue still artificially juicing these numbers. Now, at the same time, the administration's been playing games with the maturity structure of that debt. So the Treasury's been leaning harder on shorter-term instruments and trying to save a few basis points while leaving us more exposed to this rate volatility that might come about because of this shock. You can see how this just becomes a self-fulfilling prophecy. Now, this Treasury idea, which Scott Bessent criticized heavily when Janet Yellen did it, by the way, and now it's his entire playbook, it might look clever, like on a PowerPoint, but it means that we have to roll over enormous chunks of our debt more frequently at whatever rates the market demands. And what is the market demanding right now? Higher yields. See, investors are demanding compensation for political risk, inflation risk, and fiscal risk. And the bond market is looking at this administration's combination of unfunded tax cuts, tariff-driven trade tensions, and an unnecessary war and saying, you got to pay up. So layer all of this under the stress in the shadow banking system with private credit funds and BDCs and non-bank lenders where rates have been sky high for years and defaults are beginning to pick up. So in response, the Fed is reaching for this familiar dangerous playbook, loosening capital requirements to coax more lending into the real economy. And Trump is still screaming about bringing down rates. This is the quagmire of fiscal dominance. The Fed has limited policy tools in this type of environment. Like you can't just slash rates to rescue demand because that would turbocharge inflation in the middle of an oil and a food shock. Likewise, it can't hike aggressively without pushing debt servicing costs for the government even higher and detonating more landmines in private credit and housing. So it's stuck doing this awkward dance of half measures like tweaks to regulations and just praying that the bond market doesn't revolt. Now, this administration is going to try to sell you a story in the coming months. They'll say that GDP revisions were the result of that temporary shutdown, or that it's just statistical noise, or they'll tell you not even to believe their own numbers, that it's all fake news, even if they're the ones that are releasing the numbers. They'll say that the deficit spike was a wartime necessity, even though deficits were already running north of $1 trillion through February. And the tariff numbers that are in there are possibly not real. They'll praise their own toughness on energy, even as they preside over one of the most avoidable and damaging energy shocks in modern history. So your job and our job is to remember the sequencing of events. The economy was already slowing. The revisions were exposing how flimsy the growth story was. Consumer spending was already stalling, while core inflation remained stubborn. Private credit and housing were already cracking under the weight of higher rates. The deficit and debt trajectory were locking us into an era of fiscal dominance. The war didn't cause these problems. It turned them from challenges into a full-blown crisis. Now, in the days and weeks and months ahead, you're going to be bombarded with competing narratives and very selective statistics, not just from this administration, but also from the Israeli government, the Iranian governments, and from think tank experts, whose job it is to go on mainstream media and sell you this war. The safest move in wartime is to narrow your information diet. So look for outlets with people who have actually been on the ground. Read more than you watch. We're fully in the disinformation phase now, and the disinformationist in chief on our side happens to have the loudest microphone. What we can track together and what you can square with your own lived experience is what's happening to the economy in real time. The prices that you pay, the jobs you see available, the credit that's available or not in your community. Now, I'll keep cutting through the noise as best as I can, along with everyone here at Meidas, to give you a straightforward read on what's actually happening and why. So make sure to connect with me on YouTube or Blue Sky at UNFTR and sign up for my free weekly newsletter at UNFTR.com. We're ramping up the coverage and analysis as fast as we possibly can to stay ahead of this thing. And remember, resources for everything that we cover are in the notes below. For the MeidasTouch Network, I'm Max from UNFTR. Thanks as always to the Meidas Mighty for having me here, and I'll catch you next time.
Want to stay plugged in? Become a subscriber to our Substack at MeidasPlus.com. You'll get daily recaps from Ron Filipkowski, ad-free episodes of our podcast, and more exclusive content only available at MeidasPlus.com.